Being an entrepreneur is really hard. I have a lot of reverence. My grandmother used to sell coal on the side of the road. My mother's an entrepreneur. My partner's an entrepreneur. And it is hard. It is hard in whatever field you're in. The first thing is you have to be able to explain your technology in a very simple way. Like, I know that you might have gotten a PhD in plasma physics and you are going to go deep and tell me every single acronym, but that's not the way forward, because at the crux of it, you're going to be a storyteller if you're building this company.
Welcome back to Clean Techies, the #1 podcast for climate tech entrepreneurs. I'm Somil.
And I'm Silas. Each week, we publish the secrets to success from investors, founders, operators, and experts in climate tech around the world. Building a startup is hard. Building a climate tech startup is even harder. But we make it a little bit easier.
We put a lot of effort into these shows, so we hope you enjoy. Don't forget to subscribe, leave us a review, and let us know who you think we should have on next.
With that, let's get into today's episode. Hey everyone, quick note for you. You're currently listening to the free preview of this episode. If you'd like the full thing, the full shebang, go over to our Substack. That's cleantechies.substack.com/subscribe and become a paid subscriber. Any paid subscription gets you full access to the show on the Clean Techies Substack.
Amy Duffuor is the co-founder and general partner of Azolla Ventures and managing director at Prime Impact Fund. She has a diverse background that spans immigration research, management consulting, impact investing, and renewables investment banking. But all of that led her to ClimateTech. She started off by studying marginalized West African migrants and later pursued an MPhil in migration studies at Oxford. But then she transitioned into management consultant that introduced her to supply chains, and that's how she developed her passion for climate tech solutions. Her experience running venture programs in Southeast Asia actually are what introduced her to impact-driven startups and that kind of work. Prior to Azolla, Amy worked at Bank of America in the renewables sector, so she's learned a lot from that experience as well. Now, a little bit about Azolla. Azolla Ventures is a venture capital firm that focuses on early-stage investments in the climate technology startups. Their investment strategy is really unique. It blends 3 key criteria: impact, additionality, and commercial potential. In July 2023, Azolla Ventures announced their final close of a $239 million fund. Now, this fund blends catalytic charitable capital with impact-aligned market rate capital to drive investment into solutions that have deep potential for climate impact. She also has built this microcosm of LP and investor signals that they use to understand where the investing gaps are in climate tech and the climate tech funding ecosystem. She talks about this blended finance model, the unique challenges for hardware companies, and how to embed equity and justice into climate tech investing. This is a real treat. If you want to learn how blended finance is going to save climate tech, listen now. All right, Amy, welcome to the show. How are you?
I'm doing good. How are you doing? Thank you so much for having me.
Thank you for coming on. The work that you guys do is quite interesting, especially because I think one thing we're always going to talk about is it's something people aren't doing. And I think that's the point of this podcast. So I'm super excited to be talking to you today. So let's kick it off. Let's start very high level. Our favorite question to ask at the start of every episode: if you could have dinner with any clean techie, who would it be and why?
I love this question. It might be a little left field, but I would have dinner with Dr. Beverly Wright. She is an environmental justice scholar and the founder of the Deep South Center for Environmental Justice. One of the reasons that I would love to have dinner with her is she has spent a lot of time researching and talking about the kind of intersection of environmental justice and climate and also technology innovation. And she's specifically focused a lot of her work on Cancer Alley in Louisiana. It's an area where there are more than 200 petrochemical refineries and some of the highest rates of cancer actually in the US. And also many of the communities that are kind of living along kind of the polluted corridor are communities of color, specifically African American communities. And long story short, I went to Cancer Alley about 2 years ago, and it really shook me. I was there with an organization called the Descendants Project and also the 2030 Fund. The disparities, the injustice, and frankly, I think if we are not careful with how the climate tech space evolves and who we decide to be guinea pigs and who has the luxury of not having it in their backyard. We could be a very similarly extractive industry to sort of the oil and gas and petrochemical industry. And so, anyways, I'd love to have dinner with Dr. Wright and get her insights and honestly how we can be more thoughtful about integrating environmental justice into climate tech investing.
That intersection of climate and equity is something we're going to talk about on the show, but it's something that I think people sometimes have a good understanding of, but what ultimately matters is the implication of how that affects your decision making. So I'm excited to talk about that with you. I'd love to start off by, I know who you are, but the audience doesn't. So for our clean techies out there, please give us a teaser about what you're working on today.
Yeah, sure. So, Amy Duffuor, co-founder and general partner at Azolla Ventures, managing director at Prime Impact Fund, which is Azolla's predecessor vehicle. Azolla is an early stage climate tech fund, and our whole remit is investing in technology companies that each have the potential for gigaton scale climate impact. So we do this through a pretty unique model. We combine more conventional venture capital that we call full cycle capital with catalytic capital, which is primarily tax exempt capital in the US. And we use these two colors of capital to de-risk early stage climate technologies for follow-on investors. And we primarily invest in hardware companies, and we're all about focusing on overlooked and neglected areas. So what am I spending my time working on? Finding kind of, areas that a lot of climate tech VCs and other VCs aren't investing in. Spending time starting to think about fundraising, because we will likely go out to fundraise for our next vehicle. And, aside from that, just portfolio company support. You're catching me on a day when I have my most internal meetings. So I feel like every, block of hour,
The bias
I'm doing
is there, yeah.
Yeah.
Before we get ahead of ourselves, so you mentioned something, full cycle capital. What is that?
Oh, so that is the term that we use for conventional venture capital. So think about it as sort of general corpus capital.
Yeah. Okay. Amazing. And so you have a very interesting background. You went from what I would say is a number of roles in finance and consulting to now, you transitioned fully to running your own climate tech fund. So I'd love to just ask you, what put you on that journey? How would you describe your career in broad strokes?
My career in broad strokes. Well, I would first of all say it's a nonlinear career. So I always think of myself as a hybrid business, finance, and impact person. And honestly, many of the career moves that I've made have been a combination of opportunistic. And then also, I don't really think about kind of functions or jobs. I think about skill sets that I want to gain. So, when I talk about starting out my career, I started out as an immigration researcher. So, the movement of people from place to place, very much with a social justice bent. I was looking at marginalized West African migrants and how they became integrated in the UK and US. I ended up going to grad school at Oxford to do an MPhil in migration studies, got into the DPhil program, and then decided that it wasn't for me. And then what do a lot of lost people do? They end up in management consulting. So I ended up joining a management consulting firm focused on supply chain and procurement. And I worked in London for a couple of years, which supply chain and procurement, not as sexy as many people think of, but it's honestly the building blocks of businesses. And one of the projects that my consulting firm, which is called State of Flux, placed me on was in Singapore. And I fell in love with Southeast Asia. I was supposed to come back after 3 months, and it extended to 6 months, 9 months, a year. And then when they were like, Amy, you've got to come back to the UK, I was not ready for it. I wanted to stay. And I ended up transitioning to an impact investing firm called IIX. And that's where I was running early stage venture accelerator programs around Southeast Asia. So I was primarily in the Philippines and Malaysia and Singapore, really helping them think through their pain points. And so that's when I ended up getting very religious about climate change. Southeast Asia is one of the most vulnerable places in the world to climate change. And when I was at that firm, I was doing all sorts of stuff, doing like ed tech, health tech, fintech, clean energy. But I also was an investor. Somebody else made those decisions, and then I was sort of brought in to scale them. And so at that point, and this is almost a decade ago, I was like, I want to be an early stage investor, and I want to focus my career on climate. And it took me a bit of time, but I made my way back to the US, went to business school, then worked at Bank of America as a renewables investment banker. I worked on a couple of things, but the most meaningful thing to me was the IPO of Sunnova, which is a residential solar company. And like, let me tell you, that company was built by John Berger. He's the CEO and also a founder, which is quite rare. And to see them go public on the New York Stock Exchange, I was there, and to travel around the world with them during their IPO roadshow, it is such a privilege to see an entrepreneur's dream of going public become a reality. But that said, the banking life, I was not made for it. Those hours and, that lifestyle. And as soon as I felt like I had learned enough and I had that milestone, I started looking for climate tech funds who were thinking about addressing the climate crisis differently. I don't believe anything should be a one size fits all approach. And I came across my partners, Johanna Wolfson and Matthew Norden, at our predecessor Prime Impact Fund. And that's really where the journey begins.
Wow. I mean, one thing that I want to shed a bit of light on. So you said you fell in love with, Southeast Asia. I've spent a lot of time in Africa, actually, East Africa, and I think very similarly, there's a novelty about knowing these regions and I just want to hear what to you made you, fall in love with the place.
So many things. There is like an energy. I can't really explain it, but this energy and like ingenuity of just the people there, the diversity, which I think in the United States, because we are very much focused on race and, people get blanketed in broad categories. Like each country in Southeast Asia is so different and so unique. And I loved having the access through travel and through my experiences at work. And there's just such a richness and such a spirit to that region, which I find honestly really invigorating and energizing. And beyond that, on a selfish level, they're some of the most beautiful places in the world scattered around Southeast Asia. I love tropical weather, and it was a really great experience for me. I think the only downside, or the biggest downside, is I grew up in the Philadelphia area, and it's very far from home and parents, and people are aging. So.
Wow. Okay. And so kind of making sure that we set the scene fully, what we talked about, and if we can call it that, is that Azolla is almost like a blended finance fund, if we can call it that. So I'd love to hear, how did you come up with the idea to do something like that originally?
ClimateTech founders are taking on a huge challenge. Not only do they need to know how to build a startup, but they also need to deal with hardware, have a strong handle on climate policy, know how to fundraise from diverse investor types. It's a lot.
That's why we made Clean Techies, the #1 podcast for climate tech entrepreneurs. In addition to our jobs, we devote 20 hours a week to producing this podcast for you. This way you can learn from the people who have walked the path before you, learn from their mistakes, and gain insights on navigating this complex journey. If this mission resonates with you, we are asking for your help. It takes a lot of effort and it's not free.
If you are already a subscriber and want to help, start supporting us today by going to Substack and clicking Upgrade to Paid. Thanks for helping all the climate tech entrepreneurs like you.
Yeah, it's an interesting question. I would say that, first of all, I always say things are a team effort. So it wasn't really, me coming up with the idea. I operated as a team, which includes my partners, Johanna and Matthew, and then also the executive director of Prime Coalition, whose name is Sarah Carney. So when I think about blended finance funds, honestly, blended finance funds, at least when I initially had come into contact with them, was when I was working in Southeast Asia. They're often used in a development context, especially among developing countries. There are development finance institutions who put some sort of layer, of capital alongside public and private capital. And so the interesting thing about blended finance, in general, is that I think that at the core of it is that there is not a one size fits all approach, that you can be flexible and agile with the way that you're using your capital. And when I met my partners about 5 years ago, this was at the launch of our predecessor fund, Prime Impact Fund, which is not a blended finance vehicle. And so maybe I'm taking you back in time here a bit. That was a $50 million, 100% catalytic capital vehicle. And I remember when I was interviewing for that job, I said, this is really interesting, and I think that it's great for starting companies. But what I'm very much interested in is the larger blended finance version, because to me, you need to have different colors of capital, and they can support different stages of a company's life cycle. And I feel grateful that my partners at the time said, "Oh yes, that's the vision." But to get there along the way is people have corralled conventional venture capital for decades, but there hasn't been kind of the demonstration of catalytic capital at scale. And so catalytic capital, this idea that you are using primarily tax exempt capital, charitable, capital, in quotes by the IRS. And so how can we demonstrate that? And the way that we could demonstrate that was with Prime Impact Fund, the first vehicle, which was kind of smaller, 50 million. And then, that was raised in 2018. And then Azolla Ventures has a 2021 vintage. And that really outlines the evolution of our thinking, which is a paired fund structure of 240 million. It has an Azolla Ventures full cycle fund, which is 160 million approximately. It is, comprised of conventional, in quotes, venture capital. And then the catalytic fund looks actually exactly like what we did with Prime Impact Fund, but it's just a bit bigger. It's, around 80 million. So primarily tax exempt capital. And the idea is that those two funds working together in concert can provide these primarily hardware companies in the climate tech space with the sort of flexible colors of capital at different stages of their life cycle. And so honestly, we believe it's better matched to the risk and reward profile of hardware-based climate tech companies. And, we're running an experiment, one that at least initially early on is providing some really helpful data points, and it seems to be working. But I always like to think too about blended finance funds. It's an experiment that we're running, right? Because there is a need to be fluid and flexible.
I think the way you describe it as an experiment is really interesting. Inherent in an experiment are risks. And I think it's so clear to see why there's an opportunity, but I'd love to also dial back. The risks are there, and I think probably what you have the burden, but also the opportunity to do is acknowledge those risks and then build confidence around them, right? So I'm curious, in these conversations, how would you describe the risks? And also, I think what's always interesting to see is how people misinterpret the risk and kind of maybe assume it's worse than it is, or don't perfectly understand. So please tell me about the kind of things that people wonder, or the risks to this kind of a model.
Oh, I love that question. So I would say that the risks, and especially before, ClimateTech had this, exciting resurgence in like 2021 and 2022, and a ton of funds were being raised and all that jazz, I think a lot of the risk that people had with the category, especially after Clean Tech 1.0, was the stage of technology companies. Okay, so they are very early stage. We want to wait to see until they have some more proof points before we end up investing. And when I say risk, I'm primarily talking about venture investors, like why they weren't doing a similar model. Okay, so it's early stage, it's not proven out. Then there's sometimes category risk, like there have been a bunch of failures in space. And so venture investors were like, oh, we've seen that one play out again. We don't want to invest in that climate vertical because it's literally the category has had a bunch of duds. Then there's a ton of technical risk because we invest very early stage. We're not afraid of going into university labs. People will say, oh, there's a lot of technical risk at this point. And sometimes that dovetails with, we want to see the technology more proven out. There could be market risk. There are technologies that are operating in markets that actually don't exist yet. They need to be created. Sometimes venture investors don't want to take that on until there are more market signals that the sort of creation of the market is actually going to meet projected demand. And then I would also say there's like execution risk in the sense that you might have a really interesting technology, but if people have questions about the team because they're very young or not seasoned, or they come from a different sort of background that doesn't lend itself to that climate vertical, those can all be reasons why other venture investors decide not to kind of invest in the technology companies that are overlooked or neglected, or in areas that we like really lean into the risk aspect. And then you asked a question about the misinterpretation, which I find, it's really making me think. I would say that the biggest misinterpretation of the risk is that those risks can't be overcome, and that there aren't partners or people out there that actually were designed to absorb disproportionate risk, which is what our fund at Azolla Ventures is designed to do, as well as our predecessor fund, Prime Impact Fund. And so what does that mean by absorbing disproportionate risk? It means that we have catalytic capital, which is a really important layer for de-risking. It means we actually have a longer fund horizon. So, most venture funds, 10 years, we have a 15-year fund. And then, we also work as hands-on partners, with portfolio companies. Out of Azolla Ventures, we've invested in 13 companies. We have co-led or led the majority of the rounds, I believe like 12 out of 13. So like we are really getting in there. We feel like it's very important to have this governance role because we want all of our companies to be on that large scale impact pathway. So this idea that we can also the misinterpretation of there aren't partners out there to support the risk and it is too hard to support inherently risky companies on a pathway for large scale, or in our case, gigaton scale climate impact. I think those are some of the misconceptions that we've seen, and one of the reasons we exist to hopefully prove people wrong.
Yeah, 100%. And that was a very, very helpful sort of like overall setting the scene. You have experience investing sort of in, in what people call general venture, general, SaaS or things like that from, your role in impact investing in Southeast Asia. So I want to ask you, this is something I often think about because I come from a general venture background as well. What risks do you think are disproportionately focused on in climate compared to how general venture is evaluated?
Yeah, so I think the first, especially hardware, there's software and then hardware climate tech companies, and obviously there's some that cross both. I think hardware, like physical innovations in science and engineering, they are more capital intensive. You are building, a plant to produce green methanol. That is going to be much more capital intensive than some generalist company. There are also going to be more cycles. There's going to be a very long time before you are going to reach revenue. You could be a pre-revenue company until you are in your 6th, 7th, 8th, 9th year. And often, again, venture funds that are returning, they're trying to return capital within 7 to 10 years. That's going to be outside of their timeline. It's one of the reasons we have a longer fund life. There are also certain regulations that you could be, privy to, whether you are, building a project on a site and there are permitting that is required, whether you are deploying a carbon capture system along coastal communities, which is going to require some buy-in from those coastal communities in a way that is really thoughtful, and intentional, that there are going to be different opportunities. And this is for us uniquely as an impact first fund, whereby maybe you could go down a product or a revenue generation pathway that is actually not that impactful, that it might get you to financial sustainability quicker, but it's really not going to help us from, taking a big bite out of greenhouse gas emissions. And I think those are all very, very unique things that the climate tech space has as it relates to kind of general SaaS. And then you didn't ask this question, but I'm also going to just lob another one in there because I know you have a lot of entrepreneurs that listen to this podcast. I also think being an entrepreneur is really hard, very hard. I have a lot of reverence for entrepreneurs. My grandmother, who's from Ghana and no longer with us, used to sell coal on the side of the road. Honestly, until the day she died, she was known as like the local, coal old lady. So she was an entrepreneur. My mother's an entrepreneur. My partner's an entrepreneur. And it is hard. It is hard in whatever field you're in. I would also say that climate tech entrepreneurs have the added weight often of like doing something that's so impactful and good for the climate. And like all we're sort of being bombarded with is like, we got to get to 2050 is and all the time we have, or, we're not hitting our, targets X, Y, and Z. And I find that too, there's like this climate anxiety and stress and burnout that's associated, which while I believe the stress and burnout is equal across, or not equal, I think it is prevalent across all entrepreneurs. I do think there is a different dimension for climate tech entrepreneurs because of the weight that they carry.
I think one of the key things that you mentioned, especially related to how people look at hardware companies, is also the fact that people don't understand what success looks like, right? Like you said, there's so many cycles and it takes a long time to get to revenue. So what that also means is that for the generalist investor who's used to, revenue in 3 months or whatever it is, right? Like they're just not used to that kind of vision and anchoring on that. I think similar to that, you talked a little bit about, this is a bit of a tangent, but you made me think about it. You talked about how going in the lab is almost like this differentiator. And you didn't say that, but that's how I feel, which is not as much as it matters in climate tech. I don't know how many VCs can really accurately say that they know how to go into labs. So I want to talk about that for a little bit. what do you think that does to enhance your investment process? And I think I also want to take a second to understand, how do you think that makes the entrepreneurs feel, right? Maybe they might have some more inherent trust in you because they see you actually taking the time to understand the technology at its source. I just, that's such a unique thing.
No, I think you hit the nail on the head. I do think there's a level of real trust and patience and understanding. So I'll give you an example of one of our portfolio companies, Oxalis Energy. They are using CO2 electrolysis to produce green methanol for different hard to abate sectors like maritime shipping, chemicals, aviation. It's a spin out from Yale. Yale University, the CTO, Connor Rooney, was working on the technology as part of his PhD. He, developed and discovered this novel catalyst, the first sort of direct CO2 to methanol catalyst. And while he was there, met his two co-founders, the CEO Perry Backus and the COO Harrison Meyer. And, through classes and other sort of, discussions, they formed this company. And we met them when they were all still students, traveled to Yale as part of diligence, and got into the lab, was looking at sort of the prototype that they had generated, asked a ton of different technical questions, also had, contacts in our own space that either have had the experience of building electrolyzers or had developed other renewable fuels or had experience in sort of the CO2 electrolysis space. And our diligence process is pretty involved and we go deep, and it's important to us to make sure that we fundamentally understand a technology. I always joke on my team, I'm a kinesthetic learner, so it means I learn by doing and I need examples. And so if you tell me something, I'm going to say okay, I don't show me the end-to-end process. How does that work? What's the mechanism for action? What are the key technical, barriers that you need to overcome? What is that component made out of? Is that expensive? Where are you getting that from? Is this part of a supply chain that has a high risk, or there are challenges with availability? I mean, there are lots of different pieces, and I think it's important to dive deep into that. And often when you go into university labs, you've got a lot of really incredible founders who are excited about going deep, because so often venture is about the kind of surface level experiences or interactions, or hey, my friend is investing in something, so let me jump on too. And we actually take the time to understand the technology, as do many other venture investors as well that we co-invest with, and they're incredible people in the ecosystem. And we are unapologetic about that. And then also too, it's not just understanding the technology, it's understanding how that maps to really critical figures of merit for that climate vertical. So if you're dealing with a battery, I want to understand about energy density, I want to understand about round trip efficiency, I want to understand about costs, and all of those things can vary based on different verticals.
Yeah, and I was going to say, being a kinesthetic learner probably makes you a pretty good hardware investor. I feel like that's probably pretty good alignment there.
You know what? I've never made that connection, but I'm going to be doing that because I'm just show me the thing, help me understand. No, it's really fun. And while we do go into labs, I also don't want to say that the only people that we work with are founders that are just spinning out of university lab. We also go to national labs. We, spend a lot of time with, I would say, maybe more seasoned entrepreneurs who now have decided to make a transition. Perhaps they worked for an oil and gas company. Now they want to, join the clean energy transition and work for a geothermal company. And so I think there are lots of different ways, but all we want to say is, just like us, if you are not fitting the mold, if you are different or unique, or you think that there is something about your technology or your story that is less kind of linear or fits in the box, that's great, because we will take the time to try and understand it. And if we don't think it's the right fit for our fund, we'll tell you up front, and we will try to be helpful, to connect you with others that it may make more sense.
Yeah, I mean, that's the founder's, best friend, right? It's the quickest you can get to a no is saving them time. There's one thing that, as you're saying this, I realize that you have such unique insight into, as you work with founders who are commercializing, right, who are spinning out technologies. There's probably a very human process about, some founders kind of get it a little easier. How do you talk to an investor about what you're doing at the time of commercialization. You might have noticed, oh, some founders, I get it, I'm sold, I understand. And other founders like, oh, this technology is amazing, I just don't think I'm understanding it properly. So I'm wondering if you're starting to see some best practices from founders as they commercialize technologies, and anything you can share, being a VC who actually works with them, pretty closely at that stage.
Thanks for listening so far. To get the full episode, go over to Substack and become a Clean Techies premium member by selecting any paid membership. Not only will you get access to hear the rest of this episode, but you'll get access to exclusive interviews, our monthly show, the best, most relevant insights from our shows, and access to our premium community.